Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to the latest episode of the Prime Property Finance Podcast. I'm super excited to bring you this episode. A topic that's often discussed with us in the office and clients and out at events when we're networking, etc., is commercial property. We've seen a bit of a rise in the demand for commercial property, and we like to deep dive. Mark and I get into a deep dive on this topic, cover as many elements as we can around how it's assessed, the pros and cons, what type of lenders, what type of valuations. Commercial valuations is a huge topic all the time. So yeah, we're really excited to bring you this episode. Have a listen and let us know your thoughts. So as discussed, Mark, this is a pod and an episode around commercial finance and commercial property as an investment tool. So really excited to get into this one. I know it's the one that you have conversations about quite often. How are you doing?
Yeah, very good. Very good. Thank you. Looking forward to this one. There's plenty to talk about. Just hope we can keep it concise enough, not go off on a tangent as we normally do. So looking forward to this. This particular topic comes up more often than you'd think, despite most investors focusing on residential. Commercial has grown in popularity for reasons we'll cover as part of the podcast. But it'll be an interesting conversation, that's for sure.
Yeah, awesome. So a lot of the business that we deal with on a day-to-day basis tends to be, from an investor perspective, anywhere in the sort of buy-to-let, HMO, SA, bridging, auctions, all of those types of sectors. However, commercial property and commercial investment are two very different things. And also, there's commercial owner-occupier, which we will touch on as well. So do you want to just give us a bit of a breakdown as what is commercial finance, property finance, and what is the sector, and just give us a bit of a quick rundown as to the various elements of commercial property then?
Yeah, sure. So what is commercial? Commercial falls into a multitude of different things, really. Obviously, the easiest answer is there's no residential. So anything that doesn't constitute residential effectively falls into commercial. But let's define that a bit further. So we're talking about things such as hotels, office space, retail units, warehousing, like industrial housing, hospitality, pubs, all of those sorts of things. So as I say, anything that falls outside of residential, and there's a plethora of different things. If you take a look at planning use classes, I think commercial sits in every single use class that there is. So class B, E, C, E, I've already mentioned, and sui generis, which is a far broader scope on that as well. So yeah, anything outside of that, it is a very broad, hence it's a really interesting topic because this conversation can go all sorts of directions. And brings with it a bit of variety as to some of the conversations we can have.
Yeah, I guess one of the most common one that we come across in terms of generally from an investor's point of view is either, a mixed use or a semi-commercial where it's your standard high street location where you've got a shop, an office, a fast food outlet or something like that on the ground floor on the retail high street, and then either one or a number of flats above it. So it's like a multi-unit block, but because of the commercial element on the ground floor, that makes it semi-commercial. And whenever there's any element of commercial, it takes it straight away from residential in its entirety, straight into the commercial space, and that impacts the way that it's financed and also the rates that are gotten on it. So in terms of some of the other common things that common types of properties, what are you seeing at the moment that are kind of common commercial property deals that are coming across your desk?
So as I say, we get a variety. So we deal with people who want to purchase their own premises for their trading business, and we'll come on to the differences in that as well. So that often leads itself to either office space or like industrial, so storage, that sort of thing. Increasingly popular is a conversation around hospitality, in particular hotels. We did a podcast on that a couple of weeks back about the difference, whether it's an investment strategy or actually is it a property play or is it a trading play? So that's interesting as well. So that is growing in popularity. I think people are seeing there's a lot of vacant hotels around and can see the potential that sits within them. Potential doesn't always mean reality, but yeah, as I say, there is potential with it. Retail, as you say, mixed use, very commonly on the ground floor. You'll see your likes of your high street locations with some sort of retail element on the ground floor, coffee shop, or that something of that nature. And those are typically the sorts of things we see. We're actually not seeing a great deal of sort of A1 office space, which is purpose built. I think we've seen quite a plummet in values across that as post-COVID, not many people are working in the office and so on and so forth. And that falls into economic cycles, which we'll cover off in a bit as well.
Yeah, I guess one of the key things that come up for discussion, especially when we're discussing commercial property with clients, potential clients, is the difference between an owner-occupier and investment property. And I've a number of conversations where they say, "Oh, I'm interested in this property. Okay, who's the tenant? Oh, I'm thinking about putting my own business in there, or we're going to rent it ourselves." Okay, well that changes the dynamic completely between it being a commercial investment versus an owner-occupied property. Do you want to just give us a bit of a brief understanding of the difference between the two and how that impacts finance?
Yeah, sure. And great point. So they're two very different, albeit it can be the same premises, but they're two very different ways of assessing the borrowing. So let's start with owner-occupier. If you're going to put your own business in there, we have to assess the ability of your business to be able to afford the payment. So we are now looking at your last 2 years trading accounts. So you need a track record in the business. So if you're a startup also trying to buy your premises, it's extremely difficult. In fact, highly, highly unlikely that you're going to be able to do both unless you've got a lot of cash to do so. So you'll want 2 years worth of trading history, and then we'll look into your accounts to make sure there's affordability based into it. So there are certain things we can add back to do that formula, but as I say, that's pretty prescribed. Then when we look at commercial investment, you can actually have commercial investment. You don't need any track record, as in you don't need 2 years trading history accounts. You will often need to be a landlord to qualify for commercial mortgages and have some landlord experience. But we will be looking at the strength of the tenant and the rental income to assess the affordability on that. So the strength on commercial investment is very much the lease. When you think about it logically, if the tenant doesn't pay, you're likely to sue them for missed payments or what have you. If you occupy the business, occupy the premises, you're not going to sue yourself. So we have to look at the business's ability to be able to afford whatever it is the payments are going to be. Both of them can be in different structures that have been mentioned before. So very common in owner-occupier is that you have the property, the commercial property owned in its own entity, a limited company that will own it. And then the trading entity will sit outside of that. And there will be a lease agreement between the two entities in the same vein that you will own it as a commercial investment and you'll have a lease agreement with a third party that will go into that. One of the things that often gets asked is, what if a mate of mine does that, to try and circumvent the 2 year trading history by trying to get clever. The reality is it doesn't work. It needs to genuinely be a third party arm's length relationship for that lease to have any real value. Because as I say, you're unlikely to force that lease or enforce the lease in the event of non-payment.
Yeah, absolutely. And, we see the difference as well between the owner-occupier investment, and when you look at investment, whether that property is vacant or whether it's tenanted. Now, in the buy-to-let market, for instance, and we'll probably talk about valuations a little bit more further on, but if an investment if you're looking at a commercial investment and it's fully tenanted versus a potential commercial investment which is vacant, those are two very different prospects from a finance perspective, aren't they? So, it's not just as straightforward as, is this an investment or not? And are you, there's so many questions that need to be asked to determine where the financing route and whether it's got any legs goes, isn't it?
Yeah, definitely. And the other thing to consider as well is interest only, which is a very common method for investment. So interest only is very much available for that type of commercial investment relationship, whereas owner-occupier is driven predominantly towards capital and interest. Now, there are some lenders that will do interest only, absolutely. And the reason for that is owner-occupier. If it's your own business in there, we know that there is a life cycle of a business. It doesn't last forever. It usually goes for a period of growth, becomes a cash cow, and then declines. That window is usually around 15 years. So hence the reason most lenders on a commercial owner-occupier basis will be pushing you down the 15-year term. On a commercial investment, you can put multiple businesses in there. Therefore, the interest only and the longevity of the property is considered different. So those are why you'll be pushed down a shorter term and a capital and interest profile, whereas investment will be interest only.
Yeah, great point, because a lot of people, that come to commercial property for the first time make some assumptions. They know, generally on a residential basis, lenders make the assumption of a 25-year mortgage based on the life cycle of somebody working in a job and being able to afford payments over that life cycle. And so they just assume that they can come from, and in the buy-to-let space, interest only is automatic, but it's given by all lenders. Not all lenders in the commercial space will give interest only necessarily, will they? So, and like you said, they want to see that repayment profile on a much shorter basis because it just reduces their risk. And like you said, a business is generally a lot more riskier, and therefore they want to just protect their loan book effectively.
Yeah, absolutely. So I think when you're coming into this space for the first time is to be sensible about what you can do. It's not as liquid as the buy-to-let market. Therefore, lenders will lend based on that risk. So just be aware that you may be facing shorter loan terms. Another thing that some lenders may do, this is less frequent these days, but some lenders on a commercial thing will allow you to take a loan over 25 years and set the payment profile so that it pays over 25 years. However, we'll only give you a loan commitment of 5 years. So just to clarify what that means is when you get a mortgage on a buy-to-let or your own home, they lend the money to you for 25 years and it's yours for 25 years, as long as you keep up repayments and so on and so forth. Now, with a commercial property, that is different. It's unregulated for a start. But what will happen is certain lenders will only commit to the loan for you for 5 years, despite you being able to pay it over 25 years. So in theory, if their credit appetite changes or they don't like your loan anymore, they don't have to give it to you past the 5 years. And then you have to go find a new lender and so on. So as I say, less frequent than it used to be. Handelsbanken, I know, do it that way, or certainly did when I was dealing with them. And NatWest used to, but now do it the full term. So just be aware that 25 years may not mean 25 years either.
And I think this is a really great point, actually, because I think people, having come from, if they've done any type of mortgage before, resi or buy-to-let, and will see that payment profile, and they will think, right, I've got a 25-year term and I've got a 5-year fixed rate or a 5-year tracker, which isn't actually true, is it? Well, whilst it might be a 5-year fixed rate or a 5-year tracker, yes, that would be correct. However, what the lender is saying to you is, we will set up the payment terms on an affordability basis over 25 years. However, we're only going to commit to lending you this money over 5 years, which means as the anniversary of the 5th year comes up, they might say, right, we want our money back now. And you haven't got the option to go onto the standard variable rate or tie into a new deal. The term is 5 years, in which case you either have to sell the property to pay it back or refinance to another lender. So you haven't got the same flexibility that you have on those other types of loans. And people, I think, sometimes really misunderstand that because of the way that it looks compared to other types of finance products. And one of the things I talk with people about quite often is, and they come and go, oh, it's 75%, or this interest only, you're talking about two completely different finance models, and they can't be compared because you're not comparing apples with apples. And so the education piece around, the main reason we're doing this, right, is so that people can kind of understand a little bit more about how commercial finance works and how it is very, very different to buy-to-let and residential mortgages.
Yeah, definitely. It comes with, risk. Yes, the returns can be greater. It comes with more risk. You're dealing with lenders in a different capacity. Dealing with a lender on your residential home mortgage is quite a well-trodden process. So it's very defined the route that you will go down through that process, whereas commercial is genuinely a blank sheet of paper. Let's have a look at it. What is the asset? What are you planning on doing? And lenders will take all of these factors into consideration. As I say, that version of only lending for 5 years isn't as common as it used to be. And it's to do with the way that banks allocate money. So if they only committed for 5 years, they have to set aside a smaller figure on their balance sheet and so on and so forth. So we won't go into the mechanics of it. But as I say, that's becoming less of a thing. So lenders that will look at these, so the lenders we work with, like your Shawbrook, Interbay, Cambridge Counties, as I mentioned, NatWest, Lloyds, all do full length lending now. So that's less of an issue. People like Handelsbanken, Assets Capital only do the 5-year commitment. Certainly Handelsbanken used to. I haven't dealt with them for some time now. So yeah, it's worth noting.
And I know some of the horror stories, I wasn't around when it happened and I wasn't in the commercial finance space when it was, but some of the horror stories around what happened during the credit crunch with people who had commercial mortgages. I think it was a HBOS or RBS, and they just said, we're calling in our loans. And so all of a sudden they just said, right, the loans are called in, and people were saying, well, we're in the middle of a massive downturn, a global financial crisis. I've never missed a payment. Leave me, I can't refinance because there's nobody else to refinance to because of the way the market is. They'd done nothing wrong, and the bank foreclosed on them, and they were selling prop assets off at pennies on the pound, and it put a lot of people under. And so there's a lot of people that are hurting from that. So that I know, like you said, that things have changed a little bit, but it is very much more of a commercial aspect, and so it's a bit more cutthroat in that sense than and easier for the banks to take property back than it is in the residential space, where they will work harder with you to not have to repossess the property, especially if you haven't missed any payments without any reason. So there is definitely a big word of warning there as well.
Yeah, absolutely. And look, whilst we are obviously clearly going to highlight some of the negatives, there are plenty of positives attached to it as well. So this isn't scaremongering or doom and gloom. Commercial is very much a space where investors are, making some good returns, making some sound decisions, and it can very much be a space that helps you achieve your objectives. We're just here to flag and highlight some of the warnings because people step into commercial thinking it's buy to let in a different guise, and ultimately it isn't.
Yeah, absolutely. Okay, so let's talk a little bit about how commercial lending actually works then. What are underwriters looking at? How do they assess a commercial mortgage?
Okay, so for the purposes of this then, we'll just focus on investment. Owner-occupier is a different conversation. You'd be a trading business wanting to buy your own premises. So that's very much a different conversation. So let's just focus this on the investment side of this. So you're a property investor looking to move into commercial. So what is it that they're looking for? So first and foremost, they're going to want to understand your experience. So irrespective of the property type, how much money you've got, and all that sort of stuff, who are they dealing with? So what experience have you got to bring to the table? Now, that traditionally will be that you need to be a landlord of some description, whether a residential or an existing commercial landlord, for a minimum of 12 months. Okay, if you want to get into commercial, you need some property experience most of the time. Okay. So that's something to bear in mind. Is very few people, it is doable to get straight into commercial, but it's much harder. So the normal path is resi, then commercial. The next thing they're going to want to look at is they're comfortable with you. What is the commercial? So as we've sort of alluded to, the span is enormous, really, as the different property types. And even within the property types, there's nuances within that. So light industrial isn't the same all wherever it is. So is it on a retail park? Is it light industrial, a garage at the back of a lane? etc., that sort of stuff. So we really want to understand, okay, what is the property type that we're going to be lending on? The reason we want to know that is what is the demand for that property. So different to residential, we know there's a housing shortage. We know there is, a huge demand for homes right now. So the reality is if it's vacant, it's going to get filled pretty quick. In fact, there's a queue of people trying to occupy most properties these days. Commercial is very different. If, you only have to take a look at most high streets to see how many vacant retail units are on the high street these days. There's only so many vape shops you can have on a high street and barbers and so on and so forth. So, the lender's really trying to understand, okay,
if you're
what
cold,
is the
you can
demand?
get a jacket from a charity shop.
Yeah,
when you wait for a haircut.
Yeah, exactly. And that's what we're looking at is, so what is the demand for this? And it comes back to economic cycle. So a great example to demonstrate how this looked was, and we'll use COVID, were retail shops or retail outlets on the high street, selling their goods and what have you. And then COVID came along, shut everything down. So businesses had to adapt. Okay. Everybody went online if you were going to survive through the early days of COVID. And as such, people then needed storage space, not retail space. So like the pound per square foot on light industrial units went through the roof. Through COVID, you couldn't get enough space. And people were buying them as investments because they could see this demand and so on and so forth. However, fast forward 5 years, and we're now no longer reliant on these sorts of properties, and we've gone back to face-to-face and life as normal as we know it. That pound per square foot has now dropped because the demand has fallen away. So in the space of 5 years, it's gone up exponentially, but also come back down to what is a more more normalized state. So these are the things that we want to understand is what is the property type? What is the demand? Are we in a bubble? Are we in a niche, a spike, etc.? As it so happens, lenders couldn't get enough of the light industrial space during COVID. In fact, they were bringing us to find out, did we have any cases? It was that popular to get the loans out. So yeah, that's what we're looking for. Is there a demand for it? Is it niche? If it's purpose built for a chip manufacturer, then clearly, the demand for that is great whilst you've got a tenant in it. But once they go, how many other chip manufacturers are going to come behind them to go, can we have that, please? So same with office space. Obviously, it's well documented what's happened with office space. High street with retail, it's also well documented what's going on with there as well. So we want to understand that to understand the economic cycles and where are we within that and what is the likelihood if you lose this tenant, how quickly can you find another one? Because it's about voids and can you afford the mortgage and so on and so forth. So that's what we're looking for there. And then the next bit is how much do you want to borrow versus the asset value, so the loan to value. Lenders will manage their risk. So the metric they have to manage that risk is to limit the loan you can have versus the value. So very often 65% is mooted about on commercial. You can get 75%, but I would be budgeting at the 70% is probably the more normal range for these sorts of things. So those are the factors really that are being considered as far as commercial is concerned.
Yeah, so we're looking at obviously the loan to value. We're saying that the lenders generally, their risk appetite is a lot less. So they want to protect themselves against that. So they lower loan to value, 65 to 70% generally. The reason being, like you said, is there's not the same amount of people queuing up to take over a chip shop as there are to take over a 3-bed semi. Yeah, in a good location. So it just, the fact is that property is likely to be emptier for longer during that. Also, one of the changes that's come in recently from a landlord's perspective is, and this goes back to experience and, the investors' experience and what do they have and their credibility. And whilst there's, even from an investment perspective, there's not always a minimum income, but they want to see that you have some income and you have some assets in the background because they want to know that, like you said, if the property is void, it might be empty for 6 or 12 months. And one of the changes that's come in relatively recently is now you have to pay, if the property's empty as a landlord, you have to pay the business rates. And so, not just the mortgage, you've also got the business rates to cover during, and probably insurance on an empty property during the time that's vacant. So there can be considerable cost to you as the landlord during that void period.
One of the main things I've missed one out, is who's going to occupy it.
Tenant profile.
Yeah. So the tenant, as mentioned, commercial investment is heavily reliant on the lease and the covenant, or the tenant. So you'll often hear it referred to as the covenant. Now, there's a bit of a mixed thing of this. When we went through lockdown, so a lot of lenders want blue chip companies. So if Microsoft come and occupy your light industrial unit, you kind of made, aren't you? 25-year lease, etc. You know, we think brilliant. Yeah. You've got a really strong covenant. We can lend against this. It's got value. This bit of paper now has a significant amount of value because it's Microsoft. They're not going to default and so on. Versus a little startup who's, you know, going to do whatever they're going to do in your business. No capital, no track record and so on. So, however, they found through COVID, when everything happened, the ones who caused the most grief were the blue chip companies. They had the lawyers who were able to back up and withhold payment and so on and so forth. They perhaps weren't as capitalized as you may have considered. Whereas, you know, the little business whose livelihood depends on that place was not going to default because A, they've got a personal guarantee attached to it. And two, that is their livelihood. So they'll fight tooth and nail to keep that going. So, yeah, that was an interesting thing that we witnessed through COVID.
Yeah, it was an interesting dynamic.
Yeah, and I know people now who will only deal with small businesses in their commercial premises because of the horror show they had with trying to get money out of the large corporates.
Yeah, and I know we'll come on to commercial valuations shortly, but this is a really important factor. And, you know, if you use, let's say, you have one building which is a fast food outlet, and you've got two potential tenants to go in there. One would be McDonald's, and the other would be a new business startup, Mr. J's burger flipping, you know, that kind of thing. And he's just a new startup. He's decided that he's had redundancy from his work and he wants to go and become his own burger, create his own burgers. Those two tenants, it's the same building, it's the same location, it's the same rent, it's the same everything, apart from the two very different tenants. And what lenders want to see is their ability to pay, isn't it? As you said. So if this guy's a new startup, he hasn't got any experience, he's never paid rent before, he's never sold a burger before, that is a very different dynamic to McDonald's, who are obviously a huge organization which come with a great reputation and a huge financial backing. So, you know, you would take McDonald's all day long on like you said, on a 20 or 25-year lease, even if you're getting a lower rent than what you might get from him, just because of the security that you're getting on having an A-class tenant in there. And that having that, we'll come on to yields probably slightly as well, but you'll get a far better yield on a valuation on that basis because of the strength of that tenant. The lender will take a lot of comfort knowing that McDonald's aren't going to go anywhere and they will always pay their rent. Obviously, aside from what you just said but that's the theory behind it, right?
Yeah, definitely. You know, and it comes back to business type. So people always need food. You know, another great tenant is a funeral home. You know, they'll never go out of business. There will always be a demand for that. So again, it's looking at not just the property, but who's going to occupy it. You know, is it going to be a pop-up Christmas shop? Well, they're only going to be there for 6 weeks and gone again, versus a funeral home that's going to be there for the next 4,500 years, maybe, if it's a family business, and so on and so forth. So very different dynamics, and that could potentially be the same building that is being operated very, very differently because of the tenant type.
Yeah. Okay. So we've covered off loan to values. So let's talk a little bit, and I know we've done episodes on separate episodes. You can go back and look at commercial valuations because it's a hot topic that we get asked about a fair amount. So without going in, we will talk about it, but we're not going to go into super detail because we've already covered that off. But let's just talk about commercial valuations and how they differ from residential valuations in the first instance, or buy-to-let valuations.
In the valuations of residential, you have two forms of valuation. One which is going to be a short form, which is a comparable, as in it's like an A4 sheet. If you've ever seen one, there's a limited amount of information on it, enough to value the property, as you say, because it's a house and you kind of know what it is, right? So then you get what we call a long form, and it's basically a thorough valuation, and there's a lot of commentary in there on different aspects of the property. Now, in commercial, it'll always be long form. Okay, so there will always be a detailed report on the property, and they will comment on things such as demand of the businesses, where it's situated, you know, fall, all of this sort of stuff that's relevant and pertinent to that particular type of property. So if it's in a retail park, how many other units are occupied, and all of this sort of stuff will be commented upon. Again, we're speaking to demand, and how likely is it for this premises to be occupied. The lender will ask for a multiple of different valuations. Okay, I don't mean different valuation reports. Within the one report, they'll ask a few different questions. So where it's appropriate, and it's not always appropriate that we do a yield-based valuation, but where it is appropriate, they will do a commercial investment value. So we referred to a yield. So what yield is the property making? And that will then determine what the property value is going to be based on its rental income. That is going to be driven by the quality of the tenant, as we've already spoken about. The other one will be a vacant possession basis. So if that tenant disappears, okay, and the premises is empty, what is its value when it's empty? Okay. And the reason for that is they want to make sure two things: that the commercial investment value isn't 2-3 times the vacant possession value, because the covenant only increases the value by X amount. Okay. So the lender then won't just rush to the commercial investment value and say, oh yeah, you can have 70% of 2 million where the vacant possession value is 1 million because of the quality of the covenant. I guess they could potentially look to do that as long as your loan was fully repaid by the time the lease agreement ended, for example. But they will often default back to the comparable value. So what is the pound per square foot value of office space in this area? It always is those types of calculations. So it is a pound per square foot or pound per square meter value. And again, they just want to make sure there's no major differences. Where there is a difference, there you'll find they'll ratchet the LTV back down on the income-based valuation to subsequently protect themselves against the tenant leaving. You've now got an empty property that's been technically overvalued at this stage.
Yeah, and thank you. One of the things that we speak a lot about, and especially with investors, trying to get the understanding around the commercial valuations, around rental yield and valuation yield. And generally, most investors that we speak to are investing for cash flow, not necessarily for capital growth. And so if they're investing for cash flow, they're trying to get as high a yield as possible. So if we just go back to the example that we said, we've got a fast food restaurant. We've got two options. We've got McDonald's and we've got this new guy who's going to open his new burger joint. You may just keep the simple figures. You may offer the rent to McDonald's at $20,000 a year because they're going to sign up for a 20 or 25-year lease. And you know that they're good for the money, and so they can argue with you around the rent a little bit. Whereas you might charge this guy who's a bit more risky. He hasn't got any proof. You might be able to charge him 25 or 30,000 a year rent, but he might only want to sign up for a 3-year contract. So actually, rental yield is higher because you're going to make more cash flow, but it's the strength of that lease is a lot lower, which means that you will get a lower valuation. So the way that the rental yield works is the higher the rental yield, the lower the valuation, and the lower the rental yield, the higher the valuation is the way that calculation works. And so people don't struggle to get that, but hopefully that makes sense as to how that works, because of the length of the lease and the type of the tenant. So are there any break clauses? Because effectively, if McDonald's sign up on 20 grand a year for 20 years, you've effectively guaranteed £400,000 worth of rent over the next 20 years. It's guaranteed rent effectively. And so that compared to having 2 or 3 years at 30 grand, there aren't anywhere near the same guarantees. And that's why there's there would be in those two examples such a big difference in the valuation.
Yeah, definitely. So just to further talk about that is, if I offered you 2 different widgets, widget A was going to pay you 20 grand a year for the next 3 years, but widget B was going to pay you 20 grand a year for the next 25 years. Clearly, widget B will have more value. So you're going to push the value of that for it, despite the fact they're both generating the same income for years 1, 2, and 3. So, and that's where this yield piece comes in. So clearly the 25-year one has way more value. You would pay a lot more to secure that income than you would for that. And I think some people just over confuse property with being this magic thing. Well, actually, it's just a widget that generates an income, and which one are you going to pay more for? But they are the same size and shape widgets that I've got in my hands. They just happen to be producing different levels of income, and that's why that's why the differences will happen with that. And you mentioned something as well there, break clauses, which is really, really important as well. You might have a 25-year lease, but if you've got a 2-year break in it, you effectively got a 2-year lease up until that break clause. Now, once that break is gone, if there's no break clause, then you've, in theory, got a 23-year lease. So, and just to be clear, what a break clause is, as the name suggests, it's the opportunity for either, and it can go one of two ways. So if this break clause can be written however you want it to, but it basically means that either you as the landlord can break the lease without penalty, or equally the tenant can break the lease without penalty. Now, it depends how that clause is written as to who's got the right to do what, but that's what we're looking for. So when we ask you how long's the lease and is there any break clauses in it, that's what we're considering, because if it's short break, it's a short lease.
Okay, so probably a good little segue into talking about the importance of lease structures and how they impact, lending and valuations. You've obviously covered off a little bit around the valuation, but what about lending? What's the importance of a lease structure in terms of lending?
Yeah, so there are different types of leases in commercial. So you've got, if I use resi as your example, residential, you've either got an AST in England or an occupational contract. That's your agreement between both the tenant and the landlord as to the terms under which they can occupy the property. In commercial, you have a commercial lease. Now, in residential, it's very much templated and formatted, and you have to follow X, Y, and Z. In commercial, you can add a lot more into it. So FRI, so fully
repairing and insuring.
That's it, yes. Lease, so basically it's on the tenant to look after the property, and that's the most common one that you will see with that. Obviously, the stronger the covenant, the more weight they have to negotiate on some of these terms as well. So just bear that in mind as well. You may get, your Microsoft will push back on more things because they can. Whereas as the landlord to the new guy, then you got the power, really, and they just have to kind of accept it. So that's something else. The other thing as well, as mentioned, there are break clauses. So you can choose when these breaks are due to happen. You can have one, you can have two, you can have multiple. Again, that's to be negotiated between you and the tenant. And then you have rent reviews. Now, most common is up-only rent reviews. So when you review the rent, you put it up. But I do believe that's under review certainly with Welsh Government to enable the rent review down as well, because it's deemed as unfair. But those are the main parts to it.
Probably at this point, it's probably just worth saying the importance of getting, if you are going to be a landlord and you are looking at commercial property, then I highly recommend you get a solicitor to draw up a good quality lease agreement to cover you, but also to cover the tenant. But obviously, as the landlord, you want to make sure that your back is covered so that there's no questions asked around who's covering for what. Now, the tenants often don't fully understand when they, especially the newer businesses, they've never been in commercial property before. They don't understand that fully how an FRI lease works. And I've got some commercial property, and the tenant will sometimes say, "Oh, there's something needs to be done. There's a leak in the toilet, or something along those lines." And it's a case of, yeah, no worries. We'll just get a plumber out and get it sorted, because as a commercial tenant, that's your responsibility to sort those out. It's nothing to do with the landlord necessarily. So generally, if it's repairs to the external of the building, the roof or the walls, that needs to be noted within the lease. But also that depends whether you're the only tenant in occupation of that building, or whether if it's a mixed use, or if it's a commercial shared investment where you might have different occupiers on different floors or something like that. Then that would depend on, maybe the landlord would carry out the works and then charge back the works to the individual tenants, for instance. So there's a lot of things that you need to understand around the management of commercial property, and that's probably not where we're getting involved too much. That's a very different space around management and things. But from an investment perspective, one of the real benefits of getting into commercial property is it's a lot more passive, or it should be a lot more passive than your residential and your buy-to-let. Because if McDonald's signs up for 20 years, effectively you shouldn't have to do anything apart from invoice them once a quarter, probably on a commercial lease, and just collect the rent and maybe arrange the insurance and charge it back to them. Other than that, it's very low maintenance, or should be very low maintenance, apart from obviously getting involved with any disputes or voids or anything like that. So from an investment perspective, it is a lot more passive than residential or buy-to-let investment. So that's one of the real pros of commercial property, really.
Yeah. And I'm glad you mentioned legals. I don't know if now is the right time to bring it up, but when we look at reviewing the leases, when you do a commercial mortgage, the legal process is more thorough, more detailed, therefore more expensive. And you will have to have your lease reviewed as part of that, which you're looking at about £1,500 plus VAT typically to get a lease reviewed on that basis. The reason that I bring this up is if you are, because you can go online and get a template for a commercial lease. You can think you're saving yourself a few quid, but invariably you're going to have that reviewed at a cost anyway. So you might as well do it in such a way that it's right first time, because the costs add up. Or actually it can kill the loan if your lease isn't adequate. Bear in mind, you could give that to the tenant to sign. They don't have to sign a new lease to help you get a mortgage. You're now relying on them. If there's any amendments that need to be made to it, you're now relying on them to be nice and say, oh, would you mind just signing this one? And it's got some clauses in there they didn't initially agree to, and so on and so forth. So yeah, just try not to cut corners with it, as tempting as it can be, because commercial can be expensive when you're setting it up. It will save you a lot more grief in the future if you get it done properly with a solicitor.
Yeah, absolutely. So in terms of, we talked about the lease structure. One other thing is, also, if you are entering into a lease that's 7 years or more, then that has a different, they need to have, the tenant gets to have a charge on land registry to protect their interests. And there are some other pros and cons of going over that 7 years. Do you want to just share some of those?
Yeah, so as you say, there are, you need drawings as well to support, to support what the lease actually covers. Yeah, that's it. So, it's more detailed. I know a lot of commercial landlords who stay under the 7 years, because the lease is just drawn up between you and the solicitors and the tenant, etc. And that's it. There's a bit more for you to do thereafter. As I say, you probably will get into the 7 year plus territory if you've got a covenant you seriously want to keep in there. So, we've mentioned your McDonald's, your Domino's, these sorts of people off the back of that. So, and it has an additional cost, obviously, to setting up a lease over that term as well.
Yeah, absolutely. So we've talked about those different lease structures and also the importance of getting that checked out. We've talked about, how it works. Let's talk a little bit more now then around the lending, who are the types of lenders in this space? What are the rates? How does that change? Just to kind of, obviously rates change all the time, but just a bit of a scope on where things are currently in the market.
Yeah, definitely. So if I say to you that the average buy-to-let 5-year fixed rate at the moment is 5.02%, then it'll be no surprise when I say that commercial borrowing is around about the 8%, anywhere up to 10% mark, depending on who the lender is, who you are as the borrower and your level of experience, and so on and so forth. Because all interest rates are risk-based. So all pricing on a loan is how much risk am I attaching to this loan, and therefore that's the price. So that's why the interest rate in commercial is always higher, because it is a riskier space to operate in. So you could be looking at, as I say, anywhere 8, probably 7.5, if you're lucky, 7.5 to 10% is a range to be unsurprised at when you get quotes. Lenders, one of the other issues that you'll run into in commercial is the minimum loan sizes. So not all lenders are available on all property types because of the value of the properties. So they don't have a minimum property value as such. However, by virtue of having a minimum loan and then a loan to value means that the property has to be X value to qualify for that minimum loan amount. That can be anywhere from 150,000 up. I know there are some lenders which are a million plus. So that does shrink the pool of lenders that are available to people, especially the sorts of clients that we speak to who want, 200,000 high street, a shop on the high street and uppers and what have you. So just bear that in mind. There is a minimum loan requirement. That in itself then will filter some of the lenders we can go to on the high street and challenger banks.
Just generally, there's a lot less lenders in the commercial space, isn't there? So your starting pool of lenders is a lot lower, and then you bring in lower property values or quirky property types or empty properties and various things. All of a sudden, you're filtering down. You're left potentially on occasions with one or two lenders to choose from, and then the rates are higher, and people get a bit disheartened when they see those rates. But ultimately, that's why, isn't it? It's all, and we talk and we say this. I feel like we say it all the time. It's all risk based. What risk are the lender prepared to take, and what risk are you prepared to take on that deal as well?
And also, just bear in mind, so I'll use HSBC as an example. HSBC do commercial mortgages, but they don't do commercial investment mortgages. So you might look on their website and go, yeah, oh no. So they will deal with trading entities that want to buy their premises. That's their bread and butter stuff. You go and say, right, I want to buy this for investment purposes, then they won't get involved. So NatWest will do a bit of investment, but their loan to value ratio is a bit skewed. Not particularly favourable, whereas you've got more of your challenger banks who are more keen on lending this type of money, where you'll go and get your 70-75% interest only and that sort of stuff. But then you are dealing with them on a very, a very robust set of criteria. It's less blank page lending, more does it fit this? Yes, no, move on. So again, that's the sort of dynamic we're playing with in commercial.
How important are relationships with lenders in this space?
For us, exceptionally. I guess for the client, it depends whether you want to go back and you want to stay in commercial and do more of this stuff. But from our perspective, absolutely. We trade off the back of our relationship. Hopefully, as a result of doing things well, our applications are on the top of the pile. They know it's going to be written. From a borrower perspective, if you're borrowing the money for, say, 25 years and it's a life thing, so once you've got the money, it's quite transactional. If you intend on doing more in this space, then I would encourage people to develop that relationship with the lender, not because of when it goes well, but because of when it goes wrong. As always with these things, the earlier the red flags get waved and you start going to speak to the lender, that's the time where that relationship really does come into play.
Yeah, absolutely. And I think there's been, in the past, people would have a relationship with, generally businesses have a business relationship manager. And in the past, those relationship managers have been able to sign things off quite easily, on the basis that they maybe have a game of golf or they go for a couple of beers and things. But those days are long gone, aren't they? I think that's the key. It's not anywhere near as straightforward as it used to be. And it's, so... And not, like you said, you might be banking with HSBC, but you might want to do a commercial investment and they just won't do it. So we need to go to the market and see, and that's the beauty of working with a broker who understands which banks do what and at what loan to values and under what criteria set. It's a huge market. And then it's very, not a huge market necessarily, but it's a very complex market that needs to be narrowed down. And you can waste a huge amount of time and effort in trying to go in with the wrong lender. And because they're not often very quick at telling you that they won't do it either. They'll drag you down the garden path a little bit and then tell you, oh, we wouldn't have done this. We don't, so that's frustrating. And we do hear those stories.
And it's often something they knew about on day one.
Yeah.
Which is even more frustrating, is like, hang on, I flagged this straight away. But the other thing as well to note, now this is more to the owner-occupier. Just because you bank with your bank doesn't mean you should do your mortgage with the bank. Now, years ago, you had to, if you wanted a commercial mortgage with a lender, so HSBC, for example, I'll say this because I used to work there, and it was one of their criteria was if you borrowed more than 150,000, you had to bring your banking over. Those days are gone. So you can have your main banking, your transactional banking with ABC Bank and borrow from DEF Bank. That's not a thing anymore. So don't fall into the trap of thinking you have to stay with them. In fact, there's pros and there are some pros to being multi-banked. So if something doesn't go well with that bank, you're already one foot in the other camp, and so on and so forth. So just bear that in mind as well. Or from a credit perspective, not having all your eggs in one basket is a good thing. If that one bank fails, or if they change their credit appetite, which is more likely than them failing, you haven't then got to find a home for 10 commercial properties. Actually having a few around the place will help. Otherwise, you could find yourself, as you mentioned back in 2008, in that awkward position where you're having to rebank millions of pounds worth of property at a significant cost.
Yeah, absolutely. Okay, so we've talked about the various lease structures and lender types and things like that. What about, and we've talked about valuation. One of the things that people will do, and we see this in, in terms of BRR investment, buy, refurbish and refinance, and some of the, commercial can fall into that strategy quite well. And commercial properties, you often find commercial properties at auction. You'd often find empty or rundown commercial properties. Obviously there is the potential to upgrade the value of commercial properties. Not many lenders particularly like to lend a long-term mortgage on a vacant or rundown commercial property, in which case, you might need to get bridging or development finance to purchase it, or use cash to do so. And then people will say, well, I'll just get a commercial mortgage to exit that loan. Why would it be sensible to speak about getting that exit lined up front? And what kind of measures can you put in place, and what are the general type of things that you see that people do well or don't do so well in trying to line up an exit?
I think in the commercial space, too many people put hope value in place. So vacant possession, I'm going to get a tenant that's going to be worth this, it's going to yield X figure, and so on and so forth. That is just hope value. Yeah, it doesn't exist. You hope that you're going to achieve that, and it may or may not happen. But you can't lend on that basis. It has to have a degree of reality. So where we've seen it happen quite well is where people have got letters of intent from prospective occupiers. So you may not be ready yet, but you may have pre-let it. You may have, when I say pre-let it, you may have actually identified the tenant and then gone and found the property. That's another one that's gone pretty well as well in the past. That tends to happen for your likes of your Costa, your Starbucks and what have you, or your Greggs. Greggs are a great example, yeah. So they tend to occupy old banks. Traditionally, when a bank closes, a Greggs pops up in there. So if you have got a relationship with Greggs and you know what their criteria is, because they don't want to own the property, they'll rent it all, then you can then go and just go ahead of them and just be buying up this property to put them in. And you'll know what the spec is and so on. That is, I know plenty of people who do that type of strategy for multiple different, national chains and what have you. So that's where vacant premise property really can have some real value. And you speak about sweating the asset. What is good about commercial is, as we've already established, the building, might be 2 floors and this square foot or square meterage, but you can change the value by the quality of the covenant. Just by, taking out ABC business that's perhaps not as strong and then replacing them with DEF business, and they've got a much better quality, and that yield will be better. The property value will go up, but yet you've done nothing to the property other than change the tenant. So that's another thing that we see as well.
Yeah, classic. It's a classic asset management, isn't it?
Yeah.
So you might have a property that's split into 6 individual units. And, it might have 2 vacant units. You might have one that's just on a holding over lease. So the lease is at range and it's just rolling over on a month to month. And you might have another 2 or 3 that are on a 2 or 3 year lease. Well, if you go and put all of those on new 5 or 10 year leases and, fill in the empty couple of units, you just massively increase the value of that property. And not necessarily, some of it is a paper transaction around setting up the new leases and just putting a bit of effort into finding a couple of new tenants. And all of a sudden, like you said, you've managed that asset, and then you've increased the value off the back of it. So you don't necessarily need to do any refurb in order to increase the value.
Yeah, absolutely. Whereas, you could command a higher rent on a residential buy-to-let, but that doesn't change the value. It's comparable, it's still that of somebody who's bought their home and so on and so forth. So again, pros and cons to both, but if you can get commercial right, then sweating that asset asset management is a big strategy that commercial landlords use to increase the value of their property or their portfolio.
Yeah, absolutely. Okay, let's talk a little bit then around ownership structures and things, taxation and ownership structures, because when you go and buy a property for the first time, you want to be buying it in the correct manner. Obviously, for your individual circumstances, I'll do this now just to get it out of the way and throw the caveat in here that we are not tax advisors or accountants or solicitors, so we're not giving you any advice here. Just, your own particular set of circumstances, we will just discuss around some of the common structures that we see. And most purchases come through generally in a limited company name, and that could either be in an SPV, which is a special purpose vehicle that you would buy the property in, or if you're buying it, like you said, for an owner occupier, you might be buying it in the name of the trading business, although we would probably suggest that you might want to keep them separate, as you mentioned previously, with an opco-propco setup. So that's a property company and an operating company, and they lease to each other, but they are two separate companies. And also the big one, which is one of the main reasons why people get into commercial property that you can't do with residential or buy-to-let, is pensions. You have the ability to use your SIP or your SAS to fund the purchase of commercial property. And this is a sort of bit of a game changer, especially for business owners who have cash building up in the pensions, and that they can use that to buy the commercial premises that they might be renting. And instead of paying the rent to the landlord, they can pay the rent to themselves into their pension. So there's huge potential benefits there from a long-term asset play, but also taxation savings. That there's so many benefits to it. I guess the budget that's about to come out soon may impact that, because there's talks around pensions coming into inheritance tax planning, and that will shift potentially. And look, this is something that remains to be seen. And we're not going to second guess too much about what's going to come out, but it'll be interesting to see how properties owned within a pension, and how would they be able to be sold off if need be to pay an inheritance tax bill. So I'm not fully sure they fully thought out this potential change. But like I said, we're not going to dwell on that too much at the moment, because it hasn't happened, and we're not going to waste our time discussing things that haven't materialized yet. So maybe that'll be a conversation for another day, should it come in. So do you want to just talk a little bit around SIP or SAS lending particularly?
Yeah, so SIP SAS lending can be, it's a very powerful tool. As with a lot of the things that we discuss, used in the right way, can unlock, huge growth for people. So one of the things that you could potentially do is acquire, buy the premises in your SAS, so you can have a mortgage in your SAS as well. So, or your SIP or your SAS in your pension. I'll just call it a pension from now on.
Well, it might just be quickly worth defining what these are, because people may or may not have heard of them. So under normal circumstances, if you have a pension scheme through your employer, the most likely form of pension that you would have is either a defined benefit scheme or a defined contribution scheme. So there's what you're going to get at the end when you retire, or there's a defined amount of contribution going into your pot on a monthly basis. Whereas anybody is able to set up a SIP, which is a self-invested personal pension. And you could, if you wanted to opt out of your employed pension, you could transfer that pension into your SIP. So you might have a pension pot of £200,000, and you don't want to be controlled by your employer anymore, and you could transfer that into a SIP, and then you can potentially invest that into commercial property. The one that but you can also invest that in the stock market and things. The other one then is a SAS, which is a small self-administered scheme. And this is the one that's probably got a bit more flexibility, and the one that we are seeing more of, where people, again, are transferring their pensions out of their companies, or they've got a company pension because they run their own business, then they pay the money into that, and that gives them the ability to invest in commercial property using their pension. So yeah, we'll keep away from the SIP and the SAS, but we'll just say that from now on that you can use your pension to to purchase commercial property?
Yeah, definitely. So, so you buy it in your pension, and then your pension would own that asset, which you own. It's your pension. You would then, rather than you pay a mortgage still because it can still borrow, but you'd be paying rent into your pension scheme. Now, there's tax benefits for that, so it's tax free. So you're effectively paid income back into your pension. Going forward, the other thing you can potentially do, if that's an owner occupier, but if you are just doing it as commercial investment, because that also works inside a pension, and then the profits of your property company, you can pay a percentage of those profits or a portion of those profits back to your pension to recapitalize the pot, and there's a tax deduction. There's a circular thing that goes on here where you just pay out of the profits back into the pension, get the tax benefit for doing that, build up the pot, buy more commercial, and then it's a bit of a flywheel effect as you go through. So some really great things that can be done with pensions on that front. Tax as well, it's worth noting that commercial property can be opt to tax. So there could be VAT on commercial premises. So that's worth checking out. I have known deals where we found that out towards the end of the process, and that meant another 20%. So if you can imagine, that's a £500,000 purchase. It's another 100,000 that needs to be found on the last but one day type thing. You can fund the VAT as well. It's worth noting. So you can borrow, because it's really only a 3-month loan, because you'll recover the VAT as a result. One way to tell whether a property is opt to tax or not is if you pay VAT on your rent. So that's something to note as well. So if there's VAT on the rent, then it's highly likely to be a VAT-able property when you go to buy it. And then the other one that you mentioned then around the OpCo, PropCo, the other thing to note, the ownership structure, the reason why that's quite popular is that it isolates the asset, as in the commercial property, from the trading entity. So if, God forbid, anything should happen to the trading element of your business, I don't know, you may lose a major client and you might have to shut it down or what have you. If there's any monies outstanding or owing, theoretically, it should isolate the liability to that trading entity and not involve the commercial property. Whereas if you buy the commercial property in the trading entity as well, then if that business falls into difficulty, all of its assets get drawn into the conversation. So that's a big reason why a lot of people will separate out their commercial property versus their trading business.
Yeah, absolutely. And also from another option from a tax perspective is the ability to potentially claim some capital allowances, embedded capital allowances, which can offer some tax breaks on the commercial property. Just going back to the pension, one thing, generally speaking, again, more people will use their pension for the owner occupied route. And, you might have a business that has, let's say you're looking to buy a commercial property for £300,000 and the business has the cash to purchase that outright. It could be more, like we've discussed, more tax advantageous if there's two company directors and owners, they could, if there's already a pension scheme in place, they could back pay up to 60,000 per year for the last couple of years. So they could split 150 each into their own pensions and then use the pensions to purchase the property. So there's a number of things that you need to do. So if you are looking at commercial property, we're just trying to highlight some of the options available to you that you might not have even known about. And obviously we can go into much greater detail around these different structures, and there's group structures and various other things. But our job is just trying to highlight some of the options available for you. Anything else on that side from you?
Yeah, just really quickly, you mentioned capital allowances. Also, when buying commercial property, if the current vendor, the owner, has not utilized their capital allowances, you can use this as part of the negotiation. So they can sign a document that transfers the capital allowances over to you on purchase, which means that you can then subsequently claim from thereafter. If that doesn't happen, if you don't ask that question and the transaction happens, that capital allowance disappears. It's gone, so that nobody gets access to it. So it's always worth asking, have capital allowances been claimed by the current owner? If they don't know what it is, there are capital allowance experts out there who can help you with this. But that's often a very good point of negotiation. If you can raise 50 grand of capital allowances, that often changes what you can afford to pay for the property.
Yeah, absolutely. Absolutely. Okay, should we move it on then? I guess just kind of talk a little bit then around some of the pros and cons. I guess we've kind of covered a lot of it so far. I think it's just our job is just trying to educate the difference between different types of finance, namely residential and buy-to-let compared to commercial, and hopefully we've made it clear on what are those. Are there anything that jump out to you that you'd like to kind of recap on?
Yeah, so there's two things that are written down that often get overlooked, okay, in commercial, which is unique to commercial. In valuations, there can be revaluation clauses, okay? So again, on a residential mortgage, you get the property valued, you get your mortgage, and as long as you do nothing and you just keep up payments, that's kind of it. You just pay the mortgage until it's due to mature. In commercial, you'll get revaluation clauses. Typically every 5 years, the property needs to be, whether you're changing lender or not, you need to get the property revalued at your expense and present that back to the lender. And the lender will then test the value versus your loan and make sure it falls within the agreed loan covenant on that. So the loan to value covenant. This will be written in your facility letter. So you don't get mortgage illustrations and the like on commercial, you get facility letters. And in there will be all of the requirements you need to adhere to as part of your loan. And if you go in breach of any of those, you're technically in default and you can run into some challenging conversations with a lender. And the other thing which sits alongside that is that you will often have that facility letter tested every 12 months. So those covenants I mentioned, which is, is the loan to value right? Is the rental income at the set amount that we said it was going to be? The lender will often ask for evidence or management accounts of some description just to be able to test all of these covenants as well. Now, that's not strictly true with the likes of your Interbay and so on. They just lend and treat it much more like a buy-to-let mortgage. But don't be surprised when you've got to present every 12 months back to the lender that this is still in line with what was agreed at the outset. And if it's not, then you have conversations about how you're going to ratify or fix that and so on and so forth. So those two things catch people out a lot, especially the management, the testing every 12 months.
Yeah, okay, great. And then just some of the other cons then, seeing as we're on the cons of it, that, just things that, generally it's a higher entry point, so bigger deposit, sort of 35%, as we discussed earlier. Valuations are more complex. And generally, again, because of the more complex nature of it, the transaction timeline tends to be longer. So, mortgages take longer to get through, legals take longer, valuations take longer. So, the whole process takes a little bit longer than it does otherwise. The risk for potential longer void periods.
Yeah.
As we mentioned, if a tenant leaves, it's harder to, there aren't necessarily new commercial tenants queuing up to find them. And then you have to bear the cost of the mortgage, the insurance, and obviously the business rates, should there be business rates on the property. And, market sensitivity, business cycles, we've talked about values, commercial values can drop up or down depending on the market cycle and what's going on there. There are less lenders available generally, and it's a more bespoke underwriting and pricing. And then obviously, refinancing risk, if you're on a bridge or a loan, is making sure that you've got the right exit in place and considered all the options before you get into it. So those are the cons in brief. What about pros? What have we covered off? Is there anything that jumps out to you from the best elements of commercial property investment?
So from an investor standpoint, higher returns, bigger returns, so better yields on that. And as you mentioned previous, more passive in so much that the property maintenance sits with the tenant and so on and so forth. So as long as you've got a tenant that's paying their rent, there's probably little for you to do going forward on that front. So I think those are probably the two main ones. Invariably, those are the two that draw people to come and have the conversation with us in the first instance. I'm sure there are many others. Personally, I think it just offers way more variety. Not everybody likes that. Some people like the cookie cutter approach of residential, but yeah, it's more variety. You can get more creative in commercial than you can in residential, that's for sure.
I think one of the big points that are attracting people to commercial over residential at the moment is a huge change in regulation. On the residential side, tenant legislation, the Renters' Rights Bill in England, obviously the change with Rent Smart Wales, in Wales and the rights of tenants and becoming increasingly difficult to get tenants out of the property and the landlord's responsibility to upkeep those properties. That flips completely with commercial. It's far easier if a tenant doesn't pay you and just get them out. It's a lot of a slicker process. And like you said earlier, the tenants cover all the repairs and the insurance on the property. So from a management perspective, it should be a lot less management heavy on a commercial basis. And then obviously there's the big play around potential pension strategy as well, long-term wealth creation through your pension, tax efficiencies and things. It is less liquid, so it is harder to shift commercial property. However, if you've got the right property and the right structure in place, then long-term wealth creation is definitely a big tick point, being able to use those, get access to those pension funds.
Yeah. And that you try to mitigate that with doing your due diligence. I mean, we see people do due diligence on their residential purchases, but they get out of jail free card is that it's residential and somebody's going to buy it. Most likely, maybe not at the price you paid, but you can liquidate that asset fairly swiftly. So just spend more time on the due diligence, understanding market cycles and so on, just because. And this is the one thing that we see a lot is, this building's been empty for 5 years. It's a steal, it's a bargain, it's going to do this, it's going to do that. And I'm like, well, what are you going to do different? That means it's no longer going to be empty because it's been empty for 5 years for a reason. So how are you going to change that? So don't fall into the trap of seeing this wonderful opportunity. Just do your homework and anything can happen, but just do the due diligence up front.
Yeah, absolutely. Awesome. Well, look, I think that was a great episode, covered off, quite in depth the various elements of commercial property finance and commercial property investing. And we'll leave it at that unless you've got anything else you'd like to add.
No, nothing at all. Just, plenty to chew down on, I think.
Yeah, and look, and if anyone has any questions around anything that we've discussed, or you'd like us to cover any of the elements of this in any more detail, then please drop us a message. We really value the feedback that we get in. It's great to have some of the positive comments and positive reviews. So, without further ado, we'll leave it there. Thanks for your time again, Mark, and we'll catch up soon.
Yeah, thank you very much. Appreciate it.
Thanks for listening to this episode. We hope you thoroughly enjoyed that and you learned something. If you found that valuable, we would be really, really grateful if you could like and share it. Of course, if you've got any friends or family or contacts or investors that in your circles that are doing commercial property or interested in commercial property or maybe interested in what we've spoken about, then please share it with them. Don't hold it back. Hopefully if you've learned something, hopefully they'll learn something too. And as I mentioned before, if you do have any questions on anything relating to commercial property or commercial finance or anything you'd like us to go into in a bit more detail, then please let us know and we can do another episode on that. Thanks very much and see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.